This week on the Retirement Quick Tips podcast, I'm recapping the third quarter of 2024 in the markets and the economy and looking ahead to the end of the year. Today, I'm talking about the current interest rate environment and how that's impacting bonds and your bond portfolio. So the main driver for the stock market, the bond markets this year has been the Fed. So the Fed didn't do anything up until early September. And then they started cutting rates, and they did a pretty aggressive cut by historical standards and cut rates by 0.5%. That was largely anticipated, and that's why you're seeing bond prices do well this year. It's important to remember, first and foremost, when you're looking at bond portfolio and trying to kind of figure out how to invest in bonds in any type of environment, the thing to know about bonds and interest rate is that they have an inverse relationship. So when interest rates are going up like they were in 2022, you would expect bond prices to go down. And that's exactly what happened. In 2023, interest rates were pretty stable. They didn't change a whole lot. Most of the returns in bonds came from whatever interest you were receiving from those bonds, which after the rates increased in 2022, now, all of a sudden, last year and into the early part of this year, now you can get like 5% on a 1-year CD, which is just unheard of of the last 15 years prior. So a lot of the returns from bonds last year came from just reflecting that higher interest rate environment and bonds actually paying some interest again. So now you have an interesting mix where bonds are paying interest. You can earn 4 or 5% still on many bonds. However, we're in an environment now where the Fed is starting to cut rates. So interest rates are going down. You're seeing this already. If you have money markets that were paying 5%, they're not paying that anymore. They've dropped below 5%. They haven't taken a huge hit, but they're, maybe 4.7, whereas just a couple months ago, they might have been at 5.2 or 5.3. So if you understand that, what you want to do in a rate environment where rates are declining, the Fed is expected to continue to cut rates, is you want to lock in those maturities. You do not want to be sitting in short-term CDs, money markets, savings accounts. That is not the place to be in an environment where the Fed is cutting rates. Now, if you want to be more conservative and you're a bond investor, now is a great time to be investing in bonds. So one of the things I've been just pounding the table about with clients and really being active with, if you have money sitting on the sidelines, if you have money sitting in cash, excess money in a savings account, invest that. Take the opportunity to lock in rates. I'm not saying put it in the stock market, but at least put it into something that is taking advantage of the environment that we find ourselves in. Rates are still very high, but they're starting to come down. So what you need to do in that environment, if you're a fixed income investor, is take advantage of that, lock in rates. So don't be buying a bunch of 1-year CDs. Look at 3, 4, 5, 6, 7-year bonds where you can lock in the current rates for a longer period of time. Because if you look at where the direction of interest rates is headed, I don't think we're going back down to the ultra low interest rates that we've had for the last, basically since 2008. It's not going to happen. I just don't see it happening. However, we are in a period where the Fed is going to probably continue to lower rates, especially if you don't have an inflation spike. Now, there are things that could cause inflation to spike, but at this point, it actually seems like the Fed is going to be able to continue lowering rates next year and perhaps into 2025 and 2026. Likely that they'll still end up higher than what they were in the early 2010s. Basically, from 2008 to 2015, rates were at 0, and they started to tick up until COVID hit, but the rates will still probably settle in around 3% or so. At least that's the long run projection of where the Fed is going to end up. So that means rates are still going to stay high, but they are coming down. And the best time to be investing in bonds is when rates are coming down, but before they've started. So you want to lock in the rates now before they go much lower is the game plan. What I really want to emphasize is that the bond market looks really healthy right now. Rates are coming down. So you want to take advantage of that and not sit on the sidelines, sit in very short-term bonds or money markets or cash. No. We do not want to be there unless there's a specific reason why we're holding on to cash. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.